I have learned that the commercial real estate landscape, particularly vacant office buildings, may be a ticking time bomb for a potential banking crisis. With around 20% of U.S. offices sitting empty, there's a looming threat as 80% of commercial real estate loans are set to expire by 2025. In a recent video, I delved into the background and details of this issue, emphasizing its potential impact on the banking sector. If you haven't seen the video yet, I highly recommend watching it for a deeper understanding of the context. The surge in vacancy rates in the commercial office industry has already taken a toll. Recent reports indicate that delinquent commercial property loans have reached a 10-year high in various U.S. banks. The situation is particularly precarious for small to mid-size lenders, historically the backbone of the commercial real estate industry. These lenders hold approximately 80% of all commercial real estate loans in the United States, amplifying the potential impact of the crisis. Delinquencies in commercial real estate loans are on the rise, attributed to three main factors: high interest rates, the widespread adoption of remote work, and the reluctance of landlords to commit to long-term contracts amidst uncertainty. According to Financial Times, the volume of past due loans, where property owners have missed more than one payment, surged by 30%, reaching $17.7 billion in the 3 months ending September 30th. This figure rose by $10 billion in just a year, reflecting the severity of the issue. In the face of this crisis, large banks, including Wells Fargo, appear relatively calm. However, it's the smaller players in the market that are expected to bear the brunt of the storm. Wells Fargo, being the largest lender in terms of volume with over $70 billion in commercial real estate loans outstanding, saw its past due property loans increase by more than 50% to $3.4 billion in the third quarter alone. Despite these alarming figures, the question arises: why hasn't this crisis made headlines in recent financial reports? The answer lies in the cautious approach of banks like Wells Fargo. While delinquencies are on the rise, banks have been slow to put borrowers in default or declare actual losses on their growing pile of delinquent loans. In the third quarter, Wells Fargo wrote off a mere $91 million in commercial real estate loans. This seemingly insignificant write-off indicates a strategic decision by the bank, and here's where understanding the nuances of banking practices becomes crucial. Banks adhere to high-level rules for past due loans, categorizing them based on the duration of delinquency. However, the decision-making process on whether to write off a loan involves management judgment. Factors such as communication with borrowers, understanding the reasons behind delinquency, and the borrower's responsiveness play a pivotal role. Large banks, subject to regular audits, aim to document and substantiate their decisions adequately. It's not uncommon for banks to show optimism in their ability to recover funds, even if a loan sits as uncollectible for a significant period. This strategic approach by banks in managing delinquent loans highlights the complexity of the situation. Auditors play a crucial role in scrutinizing these decisions during their regular assessments. As loan delinquencies in commercial real estate continue to rise, it's likely that auditors will delve more thoroughly into the management-level decisions regarding questionable commercial loans during upcoming audits. Looking ahead, the bubble of bad commercial real estate loans may be more severe than reflected in the third-quarter financial statements of banks. As the year-end approaches in December, it's plausible that more banks will acknowledge losses related to commercial real estate loans. Wells Fargo, in its latest earnings call, expressed optimism that many borrowers would restart payments, mitigating potential losses. However, the bank's executives acknowledged that there would be some impact, indicating that the full extent of the crisis might not be apparent yet. Commercial real estate loans maturing through 2025 represent a significant portion of the banking industry's exposure. The scale of these loans, amounting to trillions of dollars, marks just the beginning of what could be a prolonged and impactful crisis. Wells Fargo's CEO admitted that there's more to come, hinting at the potential for a ripple effect across the banking sector. This raises questions about financial stability and the broader implications for the economy. In light of these developments, it's noteworthy that Jamie Dimon, CEO of J.P. Morgan, has been selling millions worth of his stake in the bank. While this could be a precautionary measure based on various factors, including market conditions, it adds another layer of speculation to the unfolding crisis. It underscores the importance of monitoring the actions of key figures in the financial sector for potential signals of broader challenges. As we navigate through the complexities of the commercial real estate crisis, it becomes apparent that the repercussions are multifaceted. The impact extends beyond the banking sector, affecting businesses, property owners, and potentially the broader economy. It raises concerns about the resilience of financial institutions and the need for proactive measures to address and mitigate the evolving challenges. Before concluding, I'd like to ask everyday Americans to share their thoughts on this issue. How do you perceive the potential impact of the rising delinquencies in commercial real estate on the broader economy? Your insights contribute to a more comprehensive understanding of the situation. In conclusion, the commercial real estate crisis, particularly the surge in delinquent loans, poses a significant threat to the banking sector and potentially the broader economy. The cautious approach of banks in managing these delinquencies, coupled with the complexities of decision-making at the management level, underscores the need for thorough scrutiny and proactive measures. As we move forward, staying informed and engaged in discussions about these challenges is crucial for navigating the evolving financial landscape. Disclaimer: the content provided is for informational purposes only and does not constitute financial advice. The author is not responsible for any actions taken based on the information provided.